Hello everyone, this video focuses on the completion of the accounting cycle. The accounting cycle, end of the period. We have defined accounting as a system that 1. Measures and records the business activities of a company, and then 2. Communicates that information to decision makers. The steps needed to deliver these two functions are known as the accounting cycle. As you know, we're studying the accounting cycle in two parts. The focus of the first part was on accounting for external transactions that take place every day of the business operation. During the first part of the accounting cycle, the accounting system 1 identifies the transactions of a business and analyzes the transactions to determine the effect on the accounting equation. 2. Records those transactions by journalizing them in chronological order in a journal. 3. Summarizes the effect of all transactions on each account by posting the amounts to the general ledger. And 4. Prepares the trial balance using the ending balance for every account from the general ledger to make certain that debits equal credits. Now let's take a look at the accounting cycle part 2. Accounting cycle part 2 takes place at the end of the period. The end of the period could be the end of a month, a quarter, or the year. The year end will consist of 12 consecutive months and could be a calendar year ending December 31st or a fiscal year ending on any month which best represents the operating results of the company. Understanding the second part of the accounting cycle requires that you understand accrual basis accounting and know the difference between accrual basis accounting and cash basis accounting. The key difference between the two is the timing of when revenues and expenses are recorded. Under accrual basis accounting, revenue is recorded when services are provided or products are delivered. Expenses are recorded when they are incurred to generate revenue. Accrual basis accounting is required by generally accepted accounting principles or GAAP. It is used by most businesses and all publicly traded companies. Under accrual basis accounting, recording transactions is not dependent on the receipt or payment of cash. Under cash basis accounting, everything is dependent on whether cash has been received or paid out. Revenue is only recorded when cash is received from customers, and expenses are recorded when cash is paid to vendors, suppliers, and employees. Revenues and expenses are recorded only at the time cash is exchanged. Cash basis accounting is used most by sole proprietorships, small businesses, and individuals when tracking their personal finances. Our focus throughout this course will be on understanding accrual basis accounting because that's what you most likely will use throughout your professional careers. The two key principles of accrual basis accounting are the revenue recognition principle and the matching principle. Like the first part of the accounting cycle that we've already studied, everything for part 2 begins with analyzing, journalizing, and posting transactions. For the second part of the accounting cycle, the big difference is the type of transactions that are getting analyzed, journalized, and posted. The focus for the first part was on external transactions that took place daily between the company and some other economic entity. The focus of the second part of the accounting cycle is on internal transactions. Internal transactions do not involve any outside parties. Internal transactions only involve updating the company's books. There are two types of internal transactions for a company: adjusting entries and closing entries. Adjusting entries are internal transactions because they are done at the corporation to record changes in assets and liabilities and the related revenues and expenses that have occurred during the period, but have not yet been recorded. Adjusting entries are a necessary part of accrual accounting due to the timing differences which require updated balances in the accounts involved. During this chapter, you will learn how to analyze, record, and post 5 types of adjusting entries. You will do adjusting entries for prepaid expenses, deferred revenues, depreciation, accrued revenues, and accrued expenses. For prepaid expenses, deferred revenues, and depreciation, you will find that cash flows take place before we recognize the revenue or expense. For accrued revenues and accrued expenses, you will find that cash flows take place after we have already recognized the revenue or expense. As you work with adjusting entries, note that every adjusting entry includes both an income statement account and a balance sheet account. Most companies record adjusting entries at the end of the month, while others may record them at the end of the quarter. Only small companies record adjusting entries annually. Once the adjusting entries have been journalized and posted to the general ledger, we need to make certain that debits equal credits by preparing an adjusted trial balance. The data for the adjusted trial balance comes directly from the general ledger ending account balances. Once completed, the adjusted trial balance provides the necessary information to complete the financial statements. All financial statements draw their data from the adjusted trial balance. The income statement, statement of stockholders' equity, balance sheet, and statement of cash flows can be prepared at this point because all accounts are updated and in balance. Now let's turn our attention to closing entries. Closing entries are internal transactions that take place only at year end. Every year we close the books on the current year and prepare the books for a new year. During the closing process, we journalize and then post to the general ledger entries that transfer the balances of revenues, expenses, and dividends to the retained earnings account. Revenues, expenses, and dividends are referred to as temporary accounts because each year their balances are zeroed out to prepare them for measuring activity for the next year. Closing entries have 2 purposes. 1, to zero out the revenues and expenses and dividend accounts to start the new year with 0 balances, and 2, to update the retained earnings account balance to include the net income and dividend distributions from the current year. Once closing entries are posted, only assets, liabilities, and stockholder equity accounts will have a balance. Those accounts always have a balance and as a result are referred to as permanent accounts. Now that the closing entries have been journalized and posted to the general ledger, we need to make certain that debits equal credits. To do so, we prepare a post-closing trial balance. The post-closing trial balance is prepared after the closing entries have been posted to the general ledger. The post-closing trial balance will include only accounts with balances in it. That means on a post-closing trial balance, you'll only have assets, liabilities, and owner's equity accounts. These accounts are referred to as permanent accounts. Unlike temporary accounts of revenues, expenses, and dividends that are zeroed out at the end of each year, so they carry a beginning balance of 0 to start the new year, the balances in permanent accounts, like assets, liabilities, and owner's equity, get carried over from one year to the next. Once the post-closing trial balance is complete and debits equal credits, the accounting cycle comes to an end. Well, that's it. The steps of the accounting cycle get repeated each and every year. We analyze daily transactions, journalize each, post the amounts to the general ledger, prepare a trial balance to make certain that debits equal credits, journalize and post adjusting entries at the end of each accounting period, prepare another trial balance called the adjusted trial balance, again to make sure that debits equal credits, prepare our financial statements to tell our financial story. Then at the end of the year, we journalize and post the closing entries and prepare a post-closing trial balance once again to make certain that debits equal credits and our books are in balance. Understanding the accounting cycle will provide you with a solid awareness of the steps needed to measure the business activities of a company and communicate the information to decision makers. This video is a little long for a brief introduction because this chapter includes so many concepts. Hope this helps you understand the entire process, because this process is something that'll take place throughout your professional careers. Thank you for taking time to watch the video. Good luck.